Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
It's excellent to be back. We've got really fascinating file on the desk today. It's in a sector everyone feels like they know, but the market signals, they're just all over the place right now.
They really are. We're looking at retail, specifically the warehouse club space. Our subject is BJ's Wholesale Club Holdings, ticker symbol BJ. And honestly, when you look at the data, it feels a bit like we're looking at a company with a serious case of middle child syndrome.
That is a very good way to put it. Just to set the scene for everyone, it is late January 2026. We are digging into the third quarter fiscal year 2025 results, which ended back on November 1st, 2025.
And we're pairing that with a pretty sharp analysis from Barron's that just came out on January 22nd, 2026.
Right.
And that middle child comment, it comes from the fact that you have Costco, right, the global giant everyone fawns over. Then you have Sam's Club, which has the whole Walmart empire behind it. And then there's BJ's.
Just sort of.
Yeah, exactly. And the valuation gap seems to scream that the market thinks BJ's is just fundamentally inferior. I was running the numbers just this morning. BJ's is trading at about, 20 times earnings?
20 times, yeah.
Meanwhile, Costco is way up in the stratosphere at 46 times earnings.
And that spread 20 versus 46, that is the absolute core of the whole investment question we have to explore today.
Is it what the bulls would call a bulk-sized opportunity, or is the market actually being smart here? I mean, usually when you see a stock trading at a 50% discount to its main peer, there's a good reason. Is it a value trap?
That is the whole debate, isn't it?
Yeah.
And to figure out if it's a trap or, a hidden gem, we really have to look at the quality of the earnings. A low PE ratio doesn't mean anything if the earnings part, is about to fall off a cliff.
Right.
We have to look at everything, the financial statements, what management said on the earnings call, their strategic position, to see if the market is punishing BJ's for, let's say, real structural problems, or if it's just ignoring a quiet, steady performer.
Okay, let's start right there with the valuation argument from that Barron's article. They call it an affordable valuation. That sounds polite.
It's very polite. It's analyst speak for cheap. The piece specifically points out that BJ's is trading at about 20.3 times forward earnings.
Okay, 20.3x.
Now, you already compared it to Costco to 46x. But get this, compared to Walmart, even Walmart is trading around 40 times earnings.
Wait, even Walmart is double the valuation. So the market is saying BJ's is significantly riskier or maybe lower quality than even a general big box store. Why? What's the penalty box for?
Well, there are a few layers to it. The first big one is something we call TAM, or the total addressable market.
Okay.
Costco and Walmart are global. They have growth stories they can sell to investors about China, about Europe, you name it. BJ's is a domestic story. It's very heavy on the East Coast of the U.S. It's just a much, much smaller pond.
So investors aren't willing to pay that world domination premium for the stock. Makes sense.
Precisely. But there's a second reason, and this one's a little more subtle. It really comes down to what they're selling, the merchandise mix. We have to draw a line between the treasure hunt model and what I'd call the supermarket model.
Okay, so this is the classic difference between going into a store for a gallon of milk and walking out with a brand new kayak versus just walking out with, a whole lot of milk.
That's it, exactly. Costco is the master of discretionary, high-ticket items, jewelry, fancy electronics, patio furniture. That treasure hunt aspect creates excitement, and it drives up how much people spend per trip.
Okay.
BJ's, on the other hand, makes the vast, vast majority of its sales from grocery staples. It operates much more like a supermarket, just in bulk. And historically, the market just gives lower multiples to these low-margin grocery businesses compared to the higher turnover general merchandise models.
So just because they sell more broccoli and fewer diamond rings, their earnings get valued less.
That's the way the market has traditionally seen it. But the counterargument, and this is what Barron's is really leaning into, is that in a shaky economy, selling broccoli is a heck of a lot safer than selling diamond rings.
Defensive versus offensive. A needs versus wants business.
You got it. And Barron's points to a Jefferies analyst who has a price target of $120 on the stock.
120. Okay, and it's trading around 94 right now.
Right, so that's about a 27% upside from where it is today. I mean, that's not a defensive return. That's a aggressive alpha they're projecting.
And I did notice there was a small note on the technicals in there. I'm usually, pretty skeptical about reading the tea leaves on charts when the fundamentals are what really matter. But what's this inverse head and shoulders pattern telling us?
And you should be skeptical, but you shouldn't just ignore it either. Technicals can often reflect a shift in sentiment before you see it in the financial reports. An inverse head and shoulders is it's a classic bullish reversal pattern. It basically suggests that the selling pressure has run out of steam and that buyers are starting to step in at progressively higher lows. When you see that, and then you also see the 50-day moving average start to curl upwards, it's a signal. It tells you the stock might be getting ready to break out of its recent trading range.
So the chart is flashing buy, and the valuation is screaming cheap. But let's pop the hood and test the engine. Let's get into the actual Q3 fiscal year 2025 performance. If the business itself is falling apart, none of that other stuff matters.
Absolutely. The top-line numbers, they look solid, but they do require a little bit of unpacking. Net sales for the quarter came in at $5.2 billion.
$5.22 billion, and that's up 4.8% year over year.
Correct.
Okay, so nearly 5% growth. For a mature retailer, that seems pretty respectable.
It is. Total revenue, which is when you add in the membership fees, hit $5.35 billion. But the number we really have to zero in on is the comparable club sales, what everyone calls the comps. Merchandise comp sales were up 1.8%.
1.8%. That feels a little sluggish, doesn't it? I mean, if inflation's still bouncing around 2 or 3%, aren't they just basically treading water?
On the surface, yes, it does look that way. But looking at just one quarter in retail is so dangerous because you can have these weird year-over-year comparisons. That's why we have to look at the stack.
I see this term in analyst notes all the time. Can you just walk us through why the 2-year stack is kind of the truth serum for retail numbers?
For sure. The stack basically filters out all the noise. Let's say last year there was a huge hurricane, and it caused a massive spike in sales of bottled water and generators at one of their clubs.
Okay.
Well, your sales this year are going to look terrible by comparison, right?
Okay.
Even if the underlying business is perfectly healthy, the SAC smooths that out by adding this year's growth to last year's growth. It gives you a much clearer picture of the trajectory.
So it's about the trend, not just the single snapshot.
Exactly. And on a 2-year stack, BJ's merchandise comps are up 3.8%. That's what's important. It's showing acceleration. It tells us that the customers they picked up are sticking around and they're layering new growth right on top of that retained business.
Okay, that makes sense. But looking through the report, there is one line item that seems to be dragging that whole average down. Total comparable club sales were only up 1.1%, and it looks like it was because of gasoline.
Ah, yes, the gasoline Mirage. This is a classic one where a lot of novice investors can get easily spooked.
Well, the report says gasoline sales had a headwind impact of negative 0.7%. To me, that sounds like revenue from gas is dropping.
Revenue's dropping, yes. But the critical question is why? Is it because people are suddenly going to Shell or Exxon instead?
Right. Are they losing customers?
No. The report is very clear on this. They sold more gallons of gas.
Oh, okay. So volume is actually up, but the price is down.
Correct. The price per gallon has fallen a lot compared to last year. So naturally, the top-line revenue number gets smaller. But, and you have to understand this strategically, BJ's doesn't sell gas to make a big profit on the fuel itself.
It's a traffic driver, the world's biggest loss leader.
It's effectively that. If the volume of gallons sold is up, that means traffic to their locations is up. A customer filling their tank is a captured audience. The chance of them then walking into the club to buy a rotisserie chicken or a case of water goes up dramatically.
So while the financial headline reads, gas revenue down, the real operational story is customer traffic up.
That is the vital distinction. The market might punish the top-line revenue miss, but the smart money should be looking at the foot traffic that it generates.
That's a great point. Okay, so let's follow those customers inside the store. How did profitability look? It seems like it held up pretty well.
It did more than just hold up. It actually expanded. Adjusted EPS was $1.16. That's up 8.4%.
So wait, sales are up around 5%, but earnings per share are up over 8%. That's a clear sign of operating leverage.
That's exactly what it is. They are squeezing more profit out of every single dollar of sales. Adjusted EBITDA was also up 4.8% to $301 million. But the metric that really impressed me the most was the stability in their gross margins.
And why is that so surprising right now?
Because the retail environment is just brutal. I mean, you have the CEO, Robert Eddy, on the call explicitly mentioning pressure from trade tariffs. Tariffs usually just crush margins. The retailer either has to eat the extra cost or they pass it on to the customer and risk losing sales volume.
And yet, their merchandise gross margin rate was flat. They didn't lose any ground at all.
which signals one of two things. Either they have real pricing power, or they have incredibly disciplined supply chain management. Probably a bit of both. They're navigating all these inflationary headwinds and tariff issues without letting their profitability bleed out. That's the mark of a really high-quality management team.
Okay, let's break down exactly what people are buying. We touched on that supermarket thesis earlier. Does the Q3 data actually confirm that BJ's is, for all intents and purposes, just a massive grocery store?
Overwhelmingly so.
Yeah.
72% of their sales? 72. It came from the grocery and perishables segment.
Wow.
We're talking fresh meat, produce, dairy, frozen foods, and that segment performed very, very strongly.
72%. I mean, that really hammers home the defensive argument, doesn't it? Even if we hit a deep recession, you don't stop buying milk and eggs for your kids. You might, put off buying that new 85-inch TV, but you're still going to buy dinner.
And that is exactly what we saw play out in their general merchandise segment. That's the other side of the coin. That segment, your electronics, apparel, home goods, it's only 10% of their total sales. And it was completely flat.
Flat. So the discretionary spending, the wants, has just stalled out.
It has. They mentioned seeing some growth in apparel and electronics, but it was basically canceled out by weakness in home goods and seasonal items. I mean, this is a read-through for the whole economy, really. It shows you the consumers prioritizing needs over wants.
Which theoretically should hurt a company like Costco more than it hurts BJ's.
In theory, yes, absolutely. Because Costco has much more exposure to that discretionary wants category. If people stop buying kayaks and high-end jewelry, Costco is going to feel that. If people stop buying new patio sets, BJ's barely even notices because it's just a rounding error compared to their deli counter sales.
Okay, let's shift gears and talk about the real engine of the business, the membership. In this warehouse model, the retail sales are almost just there to cover the overhead. The real profit is the membership fee.
It's the annuity stream. It's the high-margin recurring revenue that makes the model so powerful. Membership fee income, or MFI, was $126.3 million for the quarter.
$126.3 million, and that's up 9.8% year over year.
Almost double-digit growth. It's very strong.
But we have to play devil's advocate here. A big chunk of that has to be from the fee hike, right? They raised the price starting around January 2025. It was the first time they'd done it in 7 years.
It was.
The basic club fee went to $60, and the Club Plus went up to $120. Usually when you hike prices like that, you expect to see some members leave. You expect a churn spike.
You absolutely do. It's the biggest risk of a price increase. But the data here shows the exact opposite happen. Their tenured renewal rate is holding firm at 90%.
Why is 90% the magic number here? Why isn't 85% good enough?
In any subscription-based business, churn is the silent killer. A 90% renewal rate means that, on average, a customer stays with you for 10 years. It implies that the value proposition is so strong that the price hike was, well, it was inelastic. Customers basically shrugged and paid it.
They didn't care.
They didn't care. If that number had slipped to, say, 85%, it would be a huge red flag. It would suggest the brand is losing its grip on its members. But maintaining 90% right after a price hike, that's the strongest vote of confidence a consumer can possibly give.
And it seems they aren't just renewing. A lot of them are upgrading.
Right. This is another key data point. 41% of their entire membership base is now in that higher-tier Club Plus level.
41%. That's significant. Why would someone pay double $120 just for a membership card?
It's all about the rewards. For the consumer, it's just a simple math equation. If you spend enough at the club, the 2% cash back or the extra gas discounts literally pay for the membership fee itself, and then some.
So it's a no-brainer for a heavy user.
Exactly. But for the investor, a higher-tier member is pure gold. They visit the club more often, their average basket size is larger, and they are incredibly sticky. You don't cancel a membership that's actively paying you back.
So the membership base is not just healthy, it's getting higher in quality. But a company can't just survive on inertia. They need a forward-looking strategy. The earnings deck talks a lot about something called Fresh 2.0. To me, whenever I see a 2.0, it usually means we kind of messed up 1.0. What is this initiative really about?
You're not that far off, actually. Historically, BJ's and really all warehouse clubs operate on a philosophy of stack it high and watch it fly. The look was industrial. The produce section was Well, it was functional.
Functional is a nice way to put it.
First 2.0 is basically an admission that to really compete with traditional supermarkets, they need to start looking and feeling like one.
So we're talking about better lighting, more appealing displays, maybe strawberries that aren't bruised at the bottom of a giant plastic container?
All of the above. It's a complete overhaul of how they source and present their perishable items. The goal is to make the club feel more like a high-end grocer and less like a concrete warehouse.
That brings us right back to the valuation gap we talked about at the beginning. If their goal is truly to be a supermarket alternative, they have to steal market share from Kroger and Publix and Safeway, not just, exist alongside them.
That's the whole play. Their core value proposition is that their prices are about 25% lower than a typical grocery store. If they can offer that massive price advantage without making the customer feel like they're sacrificing quality or shopping in a dungeon, that is an incredibly compelling reason for people to switch their weekly shopping trip.
And this seems to be tied directly to their private label strategy with their Wellesley Farms and Berkeley Jensen brands.
Absolutely. Those two own brands now account for 26% of all merchandise sales.
26%, that's a huge chunk of their revenue.
And it's a margin sanctuary for them. These private label products are often made by the exact same companies that make the big national brands. But because BJ's isn't paying for a massive national advertising campaign, they can sell it for less while keeping a much fatter profit margin for themselves.
It also gives them a ton of leverage against the big consumer packaged goods companies, right? If a company like Procter & Gamble tries to raise prices too much, BJ's can just say, fine, and give more shelf space to Berkeley Jensen.
Exactly. It's a powerful tool that helps insulate them from supplier-driven inflation.
Now, I want to pivot to the digital numbers because this is where I really think the market might be missing the bigger story. Digitally enabled sales were up 30% year over year.
30%. For a brick-and-mortar retailer, that's basically hypergrowth.
But the stat that literally stopped me in my tracks was about the fulfillment mix, 90%. 90% of those digital sales are fulfilled in the club.
This is, without a doubt, the most critical point in their entire operational update. It changes everything.
Can you walk us through the economics of that? Why does it matter so much where the order is actually fulfilled?
It matters because of a little thing called the last mile. In traditional e-commerce, let's say when you order from Amazon, the retailer have to pay a company like UPS or FedEx to ship a box to your doorstep. That shipping cost absolutely destroys your profit margins, especially on heavy, low-value items like cases of water or big bags of dog food.
Right. Shipping a 50-pound bag of dog food probably costs more than the profit you were going to make on the bag in the first place.
Precisely. But the BJ's model is BOP fee buy online, pickup in club, or they bring it out to your car, curbside. The customer drives to the store. The customer pays for their own gas. The customer provides all the last-mile labor. All BJ's has to do is have an employee walk over and pick the item off the shelf.
So they get all the benefit of digital sales growth without any of the margin-crushing shipping costs.
It actually improves their labor efficiency. And, as a side benefit, it's attracting a totally different demographic. Barron's noted that this digital convenience is skewing their membership base younger. It's bringing in millennials and Gen Z who don't have the time or desire to wander up and down aisles for an hour, but still want the bulk savings.
This makes me want to explore a thought later about what this does to the value of their real estate. But first, let's check the balance sheet. All this growth and these initiatives, they cost money. Are they leveraging themselves to the hilt to pay for it all?
It's actually the complete opposite. Their balance sheet is like a fortress. Their net debt to LTM adjusted EBITDA ratio is just 0.5 times.
Half a turn of leverage. For a retailer with this much physical real estate, that is incredibly conservative.
And it gives them so much optionality. They've paid down over $2 billion in debt since 2017. They aren't burdened with servicing a massive interest bill, which means all that cash flow is free to be deployed somewhere else.
And where is that cash flow going? I know a lot of income-focused investors are probably disappointed here. They don't pay a dividend.
0% yield, that's right. But they are returning capital to shareholders, and they're doing it aggressively through share buybacks. In just the first 39 weeks of fiscal year 2025, they brought back 1.3 million of their own shares.
Spending about $135 million to do it.
Yes, and they just got a new authorization from their board for another $1 billion repurchase program that expires in January 2029.
I mean, that's a classic signal from management. They're effectively standing up and saying, we know our stock is trading at 20 times earnings, and we think that is way too cheap, so we are going to be the biggest buyers ourselves.
It's arguably the best investment they can make with their cash. If they truly believe the intrinsic value of their company is $30 or $40 a share higher, then buying back their own stock is going to generate a much better return than almost any acquisition they could make. And of course, it provides a nice little boost to EPS by reducing the total number of shares out there.
So financial health is clearly strong. Their core strategy seems to be working. What about future growth? They have about 250 clubs right now. Where do they possibly go from here?
Their plan is to open 25 to 30 new clubs over the next 2 years. But the geography of that expansion is what's really interesting. They're finally pushing west.
The presentation specifically mentioned Alabama, Kentucky, and most notably, Texas.
Texas is the bold move. It's the big one.
Texas is a retail gladiator arena. I mean, you've got Costco everywhere, you have Sam's Club everywhere, and you have H-E-B, which many people would argue is the best pure grocer in the entire country. Why would they choose to enter that kill zone?
It's definitely a calculated risk. But I think they believe their smaller store format and their very distinct fresh grocery focus allows them to slide into markets that might be saturated for another giant Costco, but still have room for a value-focused supermarket alternative.
So the strategy isn't to try and beat Costco at the warehouse game, it's to try and beat H-E-B at the price game.
Precisely. But you're right to call it a risk. Entering a brand new market like that requires building out new supply chains, new distribution centers, and building brand awareness from scratch. It is very capital intensive, and it is absolutely prone to hiccups along the way.
Which leads us nicely into the bear case. We've been pretty positive so far, but what are the big risks? What could actually derail this train?
The first risk is the consumer. CEO Robert Eddy was very, very clear on the earnings call about subdued demand for discretionary items and lower consumer confidence.
And we saw that directly in their flat general merchandise sales numbers.
Exactly. If the economy does tip into a hard recession, even a defensive name like BJ's might feel some pain. Yes, people still have to buy food, but they might start to trade down even within the store, switching from steak to ground beef or buying smaller quantities. Trading down is good for their private label share, but it can compress the total revenue number.
Okay, that makes sense. And what's the second big risk?
Competition. We can't just ignore the fact that Sam's Club has really revitalized itself over the last few years. Walmart has poured a ton of money into Sam's digital capabilities and improving their store quality. BJ's isn't competing against the sleepy Sam's Club of a decade ago anymore. They're competing against a tech-enabled, very aggressive competitor.
And Costco is. Well, Costco is just relentless.
Costco is a force of nature. If Costco ever decided it wanted to start a price war on something like rotisserie chickens or gasoline, BJ's has a lot less margin buffer to absorb that kind of hit than Costco does.
And then finally, you have the macro risks.
Inflation and tariffs. The CEO mentioned tariffs by name. If we enter a new era of trade wars, the cost of goods for things like apparel, electronics, and home goods goes up for everyone. BJ's has managed it well so far, but there's a breaking point where you simply have to raise prices, and that could really dampen consumer demand.
Okay, so let's try and synthesize all of this. On one hand, we have the bull case. Consistent growth, a super sticky membership, massive digital efficiency, and a valuation that is literally half of its peers.
And then you have the bear case, a more limited geographic runway compared to the global giants, exposure to a potentially weakening lower-income consumer, and a brutal competitive landscape as they try to enter new markets like Texas.
Barron's kind of splits the difference and concludes with a hold selective rating.
Which I think is perfectly fair. This is not a get-rich-quick stock. It's a compounder. It's a steady performer.
It feels like a defensive lineman on a football team. It's probably not going to be the one to score the winning touchdown, but it's going to stop you from losing the game.
That's a great analogy. If you are genuinely worried about market volatility, BJ's is a pretty safe place to hide. It has a floor under it. That 20x valuation provides a real margin of safety. It's highly unlikely to crash 50% because its core business is based on selling food to loyal, paying members.
Before we wrap up, I want to circle back to that digital fulfillment number we talked about, the 90% in-club fulfillment. I think there's a deeper implication there that goes way beyond just saving money on shipping.
Okay, what are you saying?
Well, if BJ's is successfully fulfilling that much digital volume from inside its existing stores, they're effectively transforming what that real estate is. These aren't just retail stores anymore, they're becoming hybrid logistics hubs.
That is a really fascinating lens to view them through.
I mean, think about it. A traditional grocery store, a Kroger or a Publix, they have a tiny little back room. They are not designed to handle a massive volume of online orders without completely clogging up the aisles or running out of space. BJ's, by its very nature, is a warehouse. They have the cubic footage built in.
So they have a built-in structural advantage in this new era of click and collect.
An enormous one. They can pivot to becoming a micro-fulfillment center far more easily and cheaply than a traditional supermarket can. They are monetizing their square footage twice. Once for the member who's physically pushing a cart through the aisles, and simultaneously as a warehouse for the digital picker who's fulfilling online orders.
That dramatically changes the math on the return on invested capital. If you start to view them as a logistics network that just happens to allow foot traffic, then the valuation multiple should, in theory, expand to reflect that tech-enabled efficiency.
It means they are future-proofed in a way that traditional grocery just is not. It's no longer just a bulk store. It's a critical distribution node in a local supply chain.
That is a very provocative thought. And if the market ever starts viewing them as a logistics play instead of just another retailer, that PE gap with a company like Costco could close very, very significantly.
It's definitely something to watch as that digital number continues to climb. If that 30% growth accelerates to 40% and they keep fulfilling it all in store, their margins are going to surprise a lot of people to the upside.
Indeed, it's a story of incredible efficiency that's kind of hiding in plain sight.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research, Mindful Markets, Measurable Meaning.